The decay in the dollar has been so great that, again, to match the real converted value of silver in 1980 at $50, you'd easily have to be a couple $100, maybe more. And in even 2011, you'd well over 100, I'm sure. So those are really sort of jokes. Our assessment is that, one, I don't know how high silver's going. I think it could go into the hundreds, 100 to 200, would not surprise me. But we're taking it in segments. My own personal investments are heavily in silver miners as opposed to gold. Though gold is the mama, it's going up. Silver has both outperformed and underperformed gold on a routine basis over the decades. So anyway, I think there's a huge explosive potential in silver, coincident with the rise in gold, but advancing more so. And so that's why my personal emphasis is in the silver aspect of the monetary metals.
Silver is entering a stage of explosive potential, both from a monetary and industrial perspective. For decades, its value has swung between underperformance and powerful surges relative to gold. Today, the metal trades at just over 1% of gold's price, an extraordinarily low historical ratio. But momentum is shifting, and technical indicators suggest that silver could soon reclaim levels that have historically marked massive breakouts. With industrial demand booming from solar panels to AI-driven technologies, alongside stagnant supply, the setup points toward higher prices that could shock many investors who still assume silver is lagging. MichaelOliver, a seasoned market analyst known for his momentum-based research and insights into monetary metals, has long highlighted the unique opportunities in silver. His work consistently emphasizes how structural shifts in market behavior foreshadow major moves before they become mainstream narratives. Silver's monetary role, combined with industrial demand and a weakening dollar, makes it one of the most compelling assets to watch. The next breakout could redefine its position in global markets. Now, we present the clips from MichaelOliver's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
The decay in the dollar has been so great that, again, to match the real converted value of silver in 1980 at $50, you'd easily have to be a couple $100, maybe more. And in even 2011, you'd well over 100, I'm sure. So those are really sort of jokes. And our assessment is that, one, I don't know how high silver's going. I think it could go into the hundreds, 100 to 200, would not surprise me. But we're taking it in segments. And my own personal investments, which we show at the end of each report, the disclaimer, are heavily in silver miners as opposed to gold. Okay, though gold is the mama, it's going up. Silver has both outperformed and underperformed gold on a routine basis over the decades. And if you go back 50 years and look at what is the highest relationship of silver to gold in any one of those given years, and plot it, we have a graph we put in the latest report. 2%, meaning divide an ounce of silver into gold, silver was 2% of the value of gold in 20 of those 50 years. So it's not absurdly, to be unexpected to see silver at 2% the price of gold. And in fact, in bull trends, like 1979, 1980, 2010 and 11, silver got up to 3.5 and higher the price of gold. Well, right now, silver's 1.12%. Still dirt cheap. It got under 1% recently, which is historically very, very low level. When you see that, buy it. But when that spread turns up, and it's been turning up sharply, well, just for example, this year, people don't realize this. Silver's up 42% on the year today. Gold's up 37%. And yet most people still think silver's lagging. It's not. It's catching up to gold. And there are certain technical levels not far above where we're trading right now that if silver spread versus gold can reach those levels, the spread chart and the momentum of the spread chart, which is what we look at, both technical metrics, have very clear pending triple top breakouts, meaning levels that they've stopped twice before. And if you punch up through that, these levels go back several years, by the way, you're breaking out big time. So if you looked at these charts, these spread relationship charts, and treated it as a price chart, you'd say, "Ooh boy, you break through that, and I'm gonna blow the cork off this thing." The spread is about to do that, I think, and when it does, I think in the next handful of months between now and the end of the year, silver's likely to be in the $60 to $70 price range. And I think the surge will also carry us highly likely to a 2% level, which again is routine. Well, that's a huge move because we're talking almost doubling the current relative value of silver to gold very rapidly and going up to that, quote, normal 2% level. Because we're, like I said, 1.12% right now. So anyway, I think there's a huge explosive potential in silver, coincident with the rise in gold, but advancing more so. And so that's why my personal emphasis is in the silver aspect of the monetary metals. Silver does have certain unique, we know the industrial aspect. It used to be, you take a picture, that silver was a key factor in photography. Now it's a key component of solar cells. And it's also, as I understand, essential in the big AI explosion because silver is such a good conductor. Okay, well, the numbers that I've seen, and I don't know the validity, they probably are because I see them from too many places, of supply demand on the industrial side is very tight. Annual production of silver is not increasing, it's plateaued, and demand is continually increasing. And by the way, China is one of the chief demanders of silver because they're like 80-90% of global solar production, solar panels, in which silver is essential. So anyway, that could become a factor where, let's say we cross 50 and CNBC needs an excuse to explain it, okay? And that's a good excuse. Oh, well, the industrial demand. Well, that's true now, but sometimes it takes a while for that reality to finally be used as the excuse. The bigger issue is silver's money, just like gold. A lot of people like to treat it as not monetary metal, but as history shows it has been. In fact, the U.S. has had silver as official money, too. So I think the crisis we're facing in global assets, global suffering, economic suffering, not just U.S., is going to be such that you're going to get a lot of things thrown up in the air in doubt, where you doubt the validity of a certain institution to provide what it's supposed to provide, like the central bank. You suddenly realize the value of the stuff in your wallet is decaying so rapidly it's ridiculous. As I said, your grandfather, father, and you, house cost, loaf of bread price when I was a kid, it's no longer 20 cents, okay? Anyway, there's a point at which the pain gets so bad that it's 52 card pickup. And I think the stock market will be a big key in that. Why? Because right now, if you look at, let's say, the average guy who's got a retirement account, maybe it's through state government pension fund or whatever, if he looks at it nominally and it's been going up because if it reflects the S&P, then it's been going up. Okay. Not a lot, by the way, over the last year, but, single-digit percent still. It's the only thing he's got to smile at. Everything else in his life is questionable. Cost of things are going up, et cetera, et cetera. And when that goes down, then it's, oh, hell, what's good? All you need then is some layoffs, et cetera, et cetera. And suddenly the average guy, instead of a sense of expectation, is a sense of doubt. And that creates fear. And when you create fear, the tone of markets change. And that's when institutions can get overthrown, ousted, abolished. And so it wouldn't surprise me that in a year or two there's no Federal Reserve. If the economy gets bad enough, which I suspect it will, there may not be any income tax, simply because it doesn't function. They go to a sales tax, etc. All kinds of things can change in big ways. I think that's the kind of situation we're facing now, pending.
Gold remains the constant in a world where central banks manipulate money supply, suppress interest rates, and create artificial booms that inevitably collapse. Every cycle follows the same rhythm. Easy money fuels asset bubbles, markets surge beyond reality, and then the unwind exposes the fragility beneath. From the dot-com bust to the 2008 crisis, history shows that no amount of rate cuts or quantitative easing can prevent the inevitable correction once excesses are baked into the system. This time, however, the bubble is larger, more prolonged, and more dependent on distorted monetary policy than ever before. When markets finally break, liquidity will not flow back into overextended equities, but into alternatives that hold real value. Historically, that's been gold, which time and again absorbs the capital fleeing financial assets. The setup today suggests that the pattern will repeat on an even greater scale. Let's get back to the interview.
So, it shows up, gold holds its value versus that ongoing degradation. It is money, period. And so other markets will also tend to try to follow degradation of money, like stock market. But gold always, over time, continues to hold its value and outpace those other assets. And therefore, the interest rate issue. If the economy weakens, yes, the central bank will then have an excuse, justification to put full throttle on it again. They're always got their foot on the pedal. I mean, they're always printing money. They're always, money supply expands. Interest rates are arbitrarily set by a central governing body. It's the most essential commodity in human interaction between you and me, or me and somebody who makes a product in China or somewhere else. I don't know who they are. Don't meet them, but I like what they do. They like the money, okay? But if what we're transferring back and forth is degrading in value, sometimes quickly, if you're in Venezuela, for example, or Weimar Republic, you get the point. But governments deem that they have the right to control that essential commodity, quantity of it, the price of it, interest rates. And so you have a manipulated, effectively socialist money. And so wise men from above are deciding, and when they see an excuse to, print, they do, man, they go crazy. Since 2009, actually it was October 2008, the Fed went to QEs. They took a chapter out of the Japanese book, and they started to go berserk, and they kept, the 15 years since, 16 years now, interest rates were effectively at zero 10 of those years. And even when they raised rates during that time, and if you go back 50 to 75 years, you'll see that Fed funds rate was still in the lower quadrant of history. So they manipulate the money, and that's what causes gold to go berserk. And therefore, this data point that we saw today is merely another little excuse for them to go berserk. And, Powell to finally give in to the other voices on the Fed and to the president and all this stuff. Print. So gold knows that. That's why. Once they help create a boom through usually monetary policy, and you can see it in the money supply or the interest rates, so forth, the stock market will participate and enjoy the party, And then when the stock market tops, ultimately it's overdone reality for a certain period of time. It's overshot any realistic level, and primarily driven by monetary policy. And it breaks, and when it starts to break, reality takes over, and the Fed can't stop it. They never have been able to do that. You go back to .com, and that peaked. It was a laborious stock market top. It wasn't like a top and a collapse. It was for a year. You toyed around between January 2000, 2001, sideways, made people feel comfortable. And in January 2001, about 6 months after the top tick in the S&P, they cut rates twice and continued to cut rates all the way down to 2002 low. Yet during that time, NASDAQ 100, representing the .com, dropped 82%. So they didn't protect anything. 2007 to 9, same story. They cut rates surprisingly. It was an ambush. September 2007, market went up, poked a new high right after that, marginally, but made a new high, all-time high, in fact. That was the top. They cut rates all the way down, market went down anyway. And it's going to happen this time. The only difference is if you stand back and look at 23 to 29, 1994 to 2000, 2002 low to 2007 high. The duration was much shorter, usually 3, 4, 5 years. And the multiple gain in the S&P, for example, is usually double, maybe triple, maybe a little bit more. But duration and multiple gain, there's no comparison this time. You go back to the 2009 low, and we've got a 10-fold advance in the S&P over 15 years, and we've got a 20-fold advance in NASDAQ 100. So dimension-wise, it's far bigger, duration-wise far bigger, meaning far more errors have been built into the system because of the distortion of the money unit. And in this bull bubble, we never had rates at free money, 10 of the 15 years, and low at the other years, lower than normal. And then the money supply also expanded rapidly. So you can understand why the bubble occurred. But once it breaks, reality tends to take over, and the Fed can take out all the hoses they want and turn on the spigot, and it just won't help. The money will go elsewhere. Where does it always go? Gold. There's a real world out there. Now, a lot of people like to think, no, there's a handful of academicians who are like gods, the Wizards of Oz up there. And when they wave their wand, that's reality. Well, no, it's not. They can distort reality for a time, defy reality, distort the money units we use to measure things, make decisions upon. I mean, when you want to buy a new house and the mortgage and all these things, or you're a factory owner, want to expand your capacity, hire more employees, or a government wants to spend, the cost of money is one of the key ingredients in your decision process. Well, if that factor is totally distorted, fake, Cheech and Chong money, okay, then you make a mistake. And when you make a mistake, it's made. Now, it may be a couple of years later before you finally realize it and reality comes back and gets you. But the exposure of all those myriad of micro and macro errors that humans make, companies make, state governments, federal governments, when it finally hits, it's so big, it's a wave that even the central bank can't stop. So when they print the money, it's always gone somewhere. In other words, not everything goes down. You go back and look, 29 to 32. 2000, 2002, 7 to 9, et cetera, et cetera. You look and you'll find there was usually two alternatives. Always one of them was gold. Now back in the 29 to 32, you couldn't do it because they banned it domestically. But home stake mining went up like 1,000%, okay, during that time. And then the other times, if you look back 2000 to 2002, gold made a low in 2000, 2001 and advanced all during that time and continued on. 2007 to 2009, the stock market had a net major decline. S&P, gold had a major advance, and continued to 2011, in fact. And by the way, a lot of people think that they remember October of 2008, where the S&P did finally, a full year into its bear market, produce what you could call a crash-type month, 35%, whoosh, in a matter of weeks. Gold did participate in that because it needed a correction anyway. But look what happened immediately after that. The context was still gold was going up, and that was a very sharp correction. Within several months, gold was back at its high, and S&P continued down till 2009. Of course, that's when they came in with QE in October of 2008, right after that crash event. That's when Bernanke said, okay, let's go full throttle. Well, what happened? S&P continued down, and gold exploded back to its high. It was benefited by the QE. So this bubble is so huge, it's hard to imagine what the consequences might be. I argue they're highly likely to be far worse than what we saw in 2008 and 9 in terms of real world, in the street folks, problems, layoffs, etc. And when you get those data points, when the stock market turns, that's when those data points the Fed likes to look at suddenly go dark. Not before, but after. And so they'll have full excuse to do what they want to do. And it'll go somewhere. Investors put it somewhere. But investors at that point usually have found out, they said, uh-oh, I made a mistake. I overdid it. Let's go somewhere else. And they usually go to T-bonds or they go to gold or both. So when they print the money, it goes somewhere, but it doesn't go back into the beast they created.
Markets thrive on confidence, but confidence is fragile when debt levels, policy missteps, and geopolitical tensions all collide. What we're witnessing today is a system stretched thin, where central banks promise stability, yet quietly admit they cannot control the long-term consequences of their own interventions. Real wealth doesn't come from speculation or relying on policymakers to bail out excess. It comes from disciplined allocation, protecting liquidity, and focusing on assets that can endure when cycles inevitably turn. History teaches us that those who prepare ahead of time are the ones who preserve and even grow their capital through turbulence. The lessons are clear. Avoid complacency, respect the weight of debt, and recognize the signals of shifting global power. Staying grounded in reality, while others chase illusions, is the real edge. Share your thoughts about MichaelOliver's analysis in the comment section below. If you find this video informative, please consider supporting us and turning on notifications to stay updated about our latest videos. See you in the following video. Thanks for watching.